Hello, and welcome back to The Road to Financial Freedom, a podcast that allows experts to share their stories and secrets to unlocking their financial independence. This podcast is brought to you by CamaPlan, a self-directed IRA administrator in Ambler, Pennsylvania, that's focused on educating investors with different ways to grow their retirement savings faster through alternative investments. And again, today we're recording this podcast episode remotely. As you know, I'm Jess Jones. I'm CamaPlan team member and the podcast host. Today's guest is President and CEO of PPR Note Company, a holding company that manages several funds that buy, sell, and hold residential mortgages nationwide. His expertise is derived from over 30 years of residential commercial real estate experience as a licensed realtor, real estate investor, and fundraiser. He is also established in the investment world as a co-founder and board member of Strategic Investor Alliance, an author, a weekly investment blogger on biggerpockets.com, and a national speaker. Please welcome Dave Van Hoorn to our podcast. Thanks for taking the time to come out and speak with us today, Dave.
Hi, Jessica. How are you doing?
Good. How have you been?
Good. Everything's well, so no complaints.
Good. Listen, with today, everything happening today, no complaints is honestly the best answer you can get. So I'm glad to hear that. I'm so excited to have you on today. I just have heard so much about your name through the grapevine just from my time at CamaPlan. So I'm excited to get to sit down and discuss a little bit more about you and get to know you a little bit more. So I'm excited to get started.
Sure. Hopefully it wasn't too much gossip. No, I'm only kidding.
Yeah, it was a lot of drama about you. I've heard you're a big drama queen. I'm just kidding. That's me.
No, there's some truth to that probably. So
No, it's been all very good things, glowing reviews. So I'm really excited to get to meet the man behind all the praise and the lovely things I've heard about you. So start by telling me a little bit more about your background. So where you were born and where you grew up, things like where you went to school, what you studied, things like that.
I was born in the Philadelphia area, so I've lived here all my life. And where I went to school, I just went to a parochial grade school, and I was raised by a single mom with 6 kids, and I was actually lucky enough to go to a private high school, take an entrance exam, and we really couldn't afford it, but I got a scholarship, and that's how I went to the high school. So I was lucky that I had good grades.
Oh,
So I was very
awesome.
fortunate.
Yeah.
And it was a college prep school in Delaware. And then I actually went to Westchester University, which is a local state college outside Philadelphia, maybe 45 minutes, an hour outside the city. And, went there for business. And then the rest was self-education from places like CamaPlan. I did go on to get a real estate license in my upper 20s. And then I had an insurance license as well. And at one point I owned a title company. And so I had done a lot of different things in those regards after college, so to speak.
Right. Mm-hmm.
I was also a contractor. I was a painting contractor for many years. And even today, my oldest son still has that company, actually, the same name, and carries it on.
Very cool. Yeah, my dad is was also a contractor, born and raised in Philly, painter and contractor. So I think we could talk a lot about things like that. I did not take on the family business.
No, why not? Well, today you have to almost be like a chemist, to
Yeah,
all the
I know.
products and liability and lead and all the different, it's a different world than years ago. And then there's a lot
Exactly.
more fancier equipment today too.
Yeah, exactly. And I think with me, it's for the best that I didn't take it on because I could definitely injure myself with a hammer or just walking, honestly. So it's probably for the best that I don't do anything that's too physically taxing. So I think my dad would rather I just stay out of that, stay out of the business. But that's really cool. I'm glad, interesting that we have that in common. So before you got involved in investing in rental properties, were you, and I know you touched on the fact that you had an insurance license and things like that, but were you involved in any other businesses or fields besides contracting during your early days as an investor? Or what was it like when you were self-teaching yourself and doing that contracting painting on the side? If you can talk a little bit more about things like that.
Yeah, well, I started painting when I was going to college, and then when I got done college, I couldn't get a job. So imagine that. And
Hmm.
so I stayed in construction, and then that's when I ended up getting a real estate license. And then I would do real estate on the side, and then work I actually worked for a contractor, and then I had started my own company. I guess I was 32 when I started my own company, and I had that for 10 years. And I stopped largely because I got injured. And
Mm,
luckily, I had enough rental properties by age 42 when I got hurt that I could live off my rental properties. So the good news was by being a realtor, it gave me access to deals. I was fairly handy as a contractor, and I knew a lot of other contractors. So that made the business somewhat easier. And then later on, I become a property manager as well when I was at a Remax. So I had done a lot of different parts of the real estate business. And,
mhm.
that made investing easier because it was like invest in what you know kind of thing.
Exactly.
So it
Yeah.
wasn't
Mhm.
that foreign to me to do because I was doing it for my clients and, now I'm doing it for myself. And
Mhm.
when you're in real estate or you're a contractor, you really don't have a retirement,
Right.
like at a company, so to speak. Most places you didn't. So you had to, retirement's on you. And
Mhm.
for me, the way to kind of bridge that gap was to have these rental properties initially, anyway.
Right. Interesting. So I'm curious, is there any person or thing that inspired you early on to become an entrepreneur while you were doing these things, or anything that inspired you to be like, maybe I'll start to learn this, teach myself this, or did it just kind of come about organically from from being a realtor and things like that?
Entrepreneur is an interesting concept because you're right. Most of us aren't really groomed to be entrepreneurs, right? But
Right.
I
Mhm.
think even as a child, I was an entrepreneur. In fourth grade, I had a paper route, and I cut lawns. I did all these different things. So I always had jobs,
Mhm.
and I was kind of like the family banker too. Like I was, all my siblings would borrow money off me. Like I was always that kid that
Yeah.
always had money. Always was the lend them money till they got paid, all that kind of stuff. So that
Mhm.
was always the case. And then I was always making money off of stuff too. Like even
Mhm.
when I had a paper route, I had my brothers delivering papers and I would make money and they would deliver, like that.
Right.
So it was always that way, even at a small age. And then I actually started selling subscriptions to the Philadelphia Inquirer at the time. I don't know, newspapers are that big today, but I would
Mhm.
go door to door and sell subscriptions and more than doubled my route and that type of thing. So I kind of learned sales and all that type of thing. And so really when I think back to the beginning of entrepreneur, it was actually as a kid, and then
Uh-huh.
just it compounds itself over time. And then even I had worked in fast food at like age 16. When I was 18, I was manager of a fast food franchise.
Oh, cool.
And not that people are proud of fast food jobs or anything.
Yeah, I've been there, believe me, we have a lot in common. You said fast food and I immediately, like, smelled the back kitchen, so yeah.
Yeah, you smell the food, right? You can't eat there
Yep.
anymore. But
Yeah.
the
Nope.
the interesting thing is though you learn a lot about systems and processes.
Yeah.
And today the business I'm in is pretty sophisticated and complicated, a little bit complicated, and knowing systems and processes helps. Even though I'm
Mhm.
probably not the best system and process person, but I know the importance of it from a managerial perspective.
Yeah, well, that's interesting. Yeah, I always think about how, miserable I was with like, being elbow deep in a tub of, like, Greek dressing, but then I remember just how much I don't even realize I picked up from it now. Like, even up at the when I started up at the front desk at CamaPlan, I was like managing 5 things at once or speaking to clients, and the little nuggets of character building or little nuggets of just information about, how to conduct yourself, how to organize your space, how to, like, all of those things just from being a fast food employee. I can't believe it was that much of a it had that much of an impact on me. That being said, I cannot eat at the restaurant I worked at. You're so right. But I am grateful for it.
They do teach you like checklists and things like that, which
Oh,
are,
yeah.
and believe it or not, real estate had a lot of checklists because you're pushing a lot of paper, and you would have
Mhm.
these folders and files, and especially pre-computer, everything was a checklist to make sure you had everything or you had all the docs. Today it's more computerized, sure, but all that came from somewhere, right?
Right, exactly. Well, that's really cool. Yeah, it's interesting to hear about the start of your journey, and I've heard that you had somewhat of an epiphany about the advantages of notes over managing a property portfolio early on in your career. So do you want to talk a little bit about this epiphany and what it changed for you, what how it changed things up for you?
Well, I mean, I got which epiphany, right? No, the
Yeah, right.
I guess with
Hey, if there are
with
multiple, feel free to
notes.
share them.
No, I guess the biggest epiphany was, notes are definitely more passive than, investing in hard real estate or renovating properties. That's definitely more
Mhm.
active usually. Now, I guess notes on the collection side could be more active, but I meant physically active, especially. And you can invest in notes pretty passively. So it's a way to invest in real estate without some of the headaches of the real estate. So I kind of like that. And I guess for me, the epiphany was, I was doing hard money lending,
Mhm.
and I was doing that out of, lines of credit I had on properties or out of my retirement account, self-directed account. And then I was also, an agent and selling properties, and I was a property manager, and I would go to court every week.
Mm.
And you're doing all these evictions and ejectments and inspections, and there were times I felt like a full-time inspector,
Yeah.
whether it was for HUD or the township or that type of thing, and or for a closing or a termite inspection or a home inspection. It just felt like I was always inspecting.
Yeah.
And when I looked at the notes, I didn't have any of that.
Mhm.
It was just money came in each month, and you looked at your bank account. It was pretty boring, but it was
Mhm.
boring can be good
Right.
sometimes when you're an investor. And it didn't have all this craziness and unpredictability and things out. Sure, there's some things outside your control, but nobody talks about vacancies. Vacancies could wipe out a year's worth of cash flow easily.
Yeah.
So nobody wants to talk about that. Now, I'm not anti real estate investing. I do a lot of it still. So,
Mhm.
but I do both, and I like the idea of being more efficient from the finance side of the business, which notes enables you to do that. And that efficiency enables you to not have to own as many houses or deal with as many headaches and still be a successful investor and still have cash flow. So I kind of like that approach of it seemed more scalable to me, and it
Mhm.
proved to be that way over time. So
Great. So do you still in terms of having you mentioned, balancing real estate and having notes and investing in both of those things, do you have a philosophy on a diverse portfolio? Do you still invest in hard money loans or anything like that? Or do you have any insight on diversification, what that means for you as an investor, or what you think new investors should keep in mind as they start diversifying their portfolios?
yes, and yes, and yes. So So, I do believe in the concept of diversification, but I
Mhm.
am probably maybe not as diversified as I should be percentage wise in some areas. But I'm more of a invest in what I know. And if it's not broke, why fix it?
Right.
So, I see people, in my case, there's some areas that I do really well in. So why would I stop doing that to go be diversified for the sake of being diversified?
Right.
I
I
call
get
that
that.
in some ways it's diversification. And I've done that. I've done where, oh, I'm diversified. Yeah. And I'm doing lousy in these other areas. So why did I do
Right.
that? So sometimes, I can see both sides of that. Yes,
Mhm.
there's a time when market conditions could, decimate an asset class or sector. And that makes sense to me. So you really shouldn't have all your eggs in one basket. But for me, some of that is more of a asset protection or things that are not tied to the market. But
Right.
it's kind of funny. Most of the things I invest in, it sounds like I'm all over the place, but I'm really not. It's usually real estate related, insurance related, or lending and banking related,
Mhm.
which is mortgages and notes and things like that. So if you really think about it, I really only invest in those same areas. And I don't really like if you called me to invest in, I don't know, a gym or a restaurant or something, I'd be like, no, no, it's not what I do. And
Right.
it took me a while to get like that. I mean, I didn't know myself well enough when I was younger. And,
Mhm.
looking back, I wish, I knew myself better and then just stuck to what I knew instead of trying to do. Sometimes I'm guilty of this, that we try to do too many things
Yeah.
and then we
Same.
end up not doing them very well. Or so I don't believe that you need to be, into 116 different things. to spread your risk around. No, I don't really believe that.
Hmm.
I believe I can invest in a handful of things, and I can segregate things and separate things and utilize asset protection and things like that. So I'm not overly concerned. I have some weird philosophies because I believe ownership brings a lot of our risk. And I think a lot of us are set up wrong in the way we own things.
Hmm. So you bring up a lot of interesting things that strike a chord with me as someone who's starting out in trying to figure out what kinds of investments I can make to make my money work harder for me, in addition to, my earned income, my salary. And I'm someone who is still at the phase in their life where I think there's times where I'm like, I need to check in with myself and say, you are acting out in a way that is not yourself. I'm still figuring out who I am. So I have a couple of questions about basically the things that you brought up. Can you tell me some more about early on some of those moments where, you learned from knowing yourself or not knowing yourself, or early successes and failures that have kind of informed the way you look at things as an investor today?
Well, a lot of the things that you do are based on age
Mhm.
and where you are in what I call the football game of life,
Mhm.
and where you are financially too, right? So, roughly the football game of life is 25 to 65, give or take a few years, right?
Mhm.
And I think, looking back, because I've done, financial planning, I've done, real estate sales to all age groups, from a couple getting married to, people, estates and stuff, so every
Mhm.
extreme, nursing homes, everything. And you see what people do, you see what their patterns are, you see how they invest, what they invest in, and especially from a financial planning and insurance capacity as well. And you see what their trends are and what their patterns are. And then you realize when you study the wealthy folks, the top 5%, you realize what was so different about those top 5%, right? And then you
Mhm.
realize it had nothing to do with, race or income or where they came from, or, and you're like, well, what was different? And a lot of it was, some of the choices they made along the way,
Mhm.
and a lot of errors in judgment, I'll call it, for lack of a better, is
Yeah.
probably between 25 and 35.
Mhm.
And then that sets the stage for what ends up happening, by the time someone's 45 and they're, I don't know, they're getting divorced or whatever's happening. It's kind of like they're midstream, and the football game, the game's coming closer to an end, so to speak. And then
Mhm.
you get into the last quarter, you see people where they're trying to make up for lost time, and you see all these
Right.
patterns, and you also see what they do with their housing choices,
Mhm.
what they do with their job choices, their transportation choices, their, all those things, and their priorities, and then where did they end up and why. And then you
Mhm.
see people that, when I look back and see the successful people, I see that they had different patterns and they had different habits and things like that. That was a big difference for me in the beginning, and I didn't even realize I was doing it. For example, I kept a lot of my properties in the very beginning. Like, my first property was a duplex,
Uh-huh.
and I know when people start out, they want to rent as much house as they can, or they want to buy as much house as they can for whatever reason. And they don't really invest intentionally, even though it's their primary. They're investing emotionally more so. Whereas me, I guess because I was an agent, I was like, no, I want to buy this duplex, live in it for a couple of years, and keep it.
Yeah.
And then I bought my next house, and I made sure the mortgage payment was less than rent or about the same as rent. And then I kept that. I had it over 10 years. And then I moved in my third property, and I still own it today. And I
Mhm.
still own my first property today,
Mhm.
And just by one simple thing, like not selling that property to buy the next one, by the time, you'll see it with couples or individuals, by the time they hit 45 or 55, and if they're doing well, the accountant is telling them to get a beach house or to go get a duplex
Uh-huh.
because you need the write offs. Well, you already owned it, you just sold it, and you already put the down payment money down, and your closing costs are thrown away. It's money out the window that you don't recover. But nobody really looks at that. They just look at what's it cost me a month, almost like a car payment or something.
Mhm.
And they're not looking at what they lost along the way. And if they had kept the houses initially, or a condo or a townhouse initially, and they kept it as a rental, well, their tax advantages are dramatically different. Because I
Right.
was a big tax guy. I was an accounting major in school. Not that I became an accountant, but I was an accounting major for 3 years. And you
Uh-huh.
learned enough to be dangerous, and you learned enough about taxes. And because I didn't have a lot of money or means, I realized every dollar I saved in taxes could be one more dollar I had to invest.
Mhm.
So I was very, now you know why I'm friends with Carl and CamaPlan and all the
Mhm.
folks over there is because, it's a tax favored treatment vehicle type thing. And, I'm big on that kind of thing. So,
Mhm. Cool. Thank you for sharing that. I think that that's, everything you're saying is very helpful for, I know, me as a young woman who's just starting to invest. And I think that this will be helpful for a lot of our listeners to hear, especially from someone who's so far and successful in their career, to hear that from someone like you and how you looked at people who are far and successful in their careers when you were starting out early on. I think that it's really helpful to hear. I also appreciate how there's a balance with risk with you. You know what I mean? There's the sense that you do need to take these risks and take a leap into something that you may not necessarily know entirely, but you educate yourself, you learn more about it, you invest in what you know and grow from there. But there's also that sense of like risk evaluation. Don't invest in 116 different things just for the sake of having diversification in your portfolio. So, do you have any characteristics you think make a successful investor, like someone ambitious, risk taking, things like that? What are some of the biggest pitfalls you think people should avoid, or what are some of the characteristics that make someone that successful investor?
well, you do have to be willing to take some kind of risk, right?
Right,
And
exactly.
of course, I've lost money along the way, right? So
Mhm.
you will lose money, and that's how you learn. But you would never get to where you are if you didn't learn.
Right,
And you're learning from the times you do lose. Now, the lesson is hopefully not to repeat it.
right, exactly.
But I mean, we do a lot of diligence today.
Right.
We do a ton of diligence on counterparties. We do a ton of diligence on JV partners. We do a lot of diligence today, more so than I probably ever did in my life. So, as a company, we do a lot more research and diligence than we ever did. And
Mhm,
we primarily invest in what we know, right?
mhm.
But there's still risks. There's
Right.
still stuff that's outside our control. And when things happen that are outside your control, it's more about how you react or respond than it is what happened. It's more about what you did, assessing the situation.
Mhm.
COVID's a perfect example.
Right.
You see where, or anything, any kind of, it's how prepared are you? Now, can you prepare for everything? I mean, no. I mean,
Right.
what can you do to overcome or turn a negative into a positive type thing? And that's it's a little bit different. That's more of mindset and how you view things, and I think there's a lot that goes into some of that a lot of it is all the distraction and noise around us.
Mhm.
Your brain's like a computer, and it's like what you let into it is positive or negative, and that it could change your outlook on a dime, so
Mhm.
to speak. Almost like when you're angry versus, you can't be grateful and angry at the same time kind of thing.
Yeah. Mhm. Interesting. Well, thank you. I think that this is, I mean, as someone who literally won't even has to risk assess like a date, I think that this is helpful to you. Sometimes you just have
Risk
to take
assess
the
a
leap.
date.
Yeah. Just like,
You
what is what's the long-term
well, you know
involvement
what?
here?
I was pretty shy as a young guy. I'm
Uh-huh.
probably not as bad now, but yeah, I don't know. It would be hard for me to go on a date. I've been married so long.
I know, right? And the online scene and COVID, I don't think makes anything easier for anyone, but I'm like, I'm that's just an example of
Yeah, it's true. I didn't think about that. I can't. Yeah,
right?
that's.
Oh, man,
Yeah,
I've
I don't know.
heard so many horror
Yeah,
stories from
that's.
my friends, but I'm the kind of person who literally won't even take a risk and leap onto a dating app or something like that, you know what I mean? So it's I think
Yeah,
it's
yeah,
helpful to hear, that there is unless you take those risks, you're not gonna learn anything unless you make a mistake and learn from it. So I think that that's helpful to hear. So thanks for sharing your insight on that. I appreciate it. So I'm interested to hear some more about the note rehabbing and seasoning that you do for sale. Can you describe the process of rehabbing and seasoning notes?
Yeah, I mean, what we do in its simplest form is, we raise a lot of capital and then we go buy distressed mortgages from servicers or government agencies and things like that.
Hmm.
And then we work through those assets. They're either vacant or occupied. If we can keep people in their homes, we do. We're all about community stabilization and trying to keep people in their homes if we can. If they're vacant properties, obviously we have to, liquidate the assets or get the property back on the tax rolls kind of thing. Whether we sell it off or renovate it or rent it out or refinance it, like there's a whole multitude of exits. But yeah, once we get a note reperforming, then oftentimes we will hold it for some level of seasoning because it'll increase the value of the asset after it's reperforming for a while.
Hmm.
And then we get better execution if we do that. And then we sell them off to investors. And then, we sell non-performing once in a while too. And so we do a little bit of all the above. And then we have fund investors
Hmm.
that like to invest into a pool of loans where they are diversified in a sense throughout the country, different types of properties, not necessarily all in one geography. That's one of the things when I'm, as a smaller real estate investor locally in the Philadelphia area, for example,
Hmm.
a lot of my risk is in one area,
Right.
which is riskier than people think sometimes.
Mm-hmm.
That's definitely an advantage in the note investing world. You can have, we own, we bought over, I think, 9,000 or more loans. We own loans everywhere,
Right.
and
Yeah.
you're pretty spread out, when you think about it. So it's very unusual for us to have a significant impact in any one location that would be super detrimental to us or something. So whereas if, the strike of a pen, like I invest in one county, right?
Hmm.
If they change the laws in that county or eviction or whatever, it could dramatically impact that
Right.
portfolio.
Yeah. Interesting. So this is what PPR does, right? And this is the PPR funds that you're describing?
Yes.
Okay.
Yeah, the PBR funds invest in non-performing mortgages. And then we also have liquidity funds too that invest in mostly reperforming loans or some hard money lending type assets. And they're more short term. So we do have a liquidity fund. Right now, we have an offering at 6 months, for example. So it's short term.
Hmm.
And then we have longer term funds that are like 1 year and 3 year options.
Okay. So you described that you have a lot of clientele, or you notes that you have rehabbed and seasoned are from pretty much nationwide. Could you describe a typical note buyer for PPR if there is one? And what are some of the benefits a note buyer for PPR can expect, and what exactly are PPR note auctions? Because I'm kind of interested I hear auction, but I don't know if they're exactly what I am thinking when I hear about a PPR note auction. So if you want to talk a little bit more about those things.
Well, yes. I mean, we do sell reperforming loans. I mean, it's
Mhm.
pretty much open to anyone, but a lot of the people that buy these reperforming loans are typical real estate investors a lot of times.
Mhm.
They just seem to be able to get their mind around it easier, I guess. And a lot of times they're really just investing for cash flow. And I think one of the things they like about us is we do have a note warranty on our
Mhm.
reperforming junior liens. And, people like that because, they have an option to sell the loan back if it were to redefault, or they feel like they have a safety net with us. And then we have a long track record. We've been doing it a long time.
Right.
We're in our, what is it, 13th year, something like that. So, people feel they trust us and know us. And so we do sell a lot of notes that way. And it is a unique way to invest, and
Mhm.
people do it in their qualified plans, self-directed qualified plans, right?
Right.
So, if you can cash flow pretty well in a tax sheltered environment and, it's not too shabby, right? And then
Right.
you can do notes in an infinite number of ways, though. I mean, I know a heating and air conditioning guy who finances heater installations and
Mhm.
holds the paper on that. I know people, I know a dentist that finances dental work, right? So
Mhm.
nobody says it has to be a note and mortgage like Dave Van Horn does at PPR. It could be
Right.
other types of financing. There's, all kinds of debt, medical debt, auto debt, student loan debt, it just goes on and on and on.
Mhm. Definitely. How did you create the note funds for accredited investors that you created?
Well, in the truest sense, it's
Mhm.
with a securities attorney.
Right.
But really, you're just, there's legal ways to pool money. or
Mhm.
raise money, and then there's not so legal ways to raise money.
Right.
And yeah, so obviously we're trying to do the right thing. And that's why at some point, especially as you grow in size, it makes sense to have the right team. And in this case, it would be a securities attorney. But no, I've been syndicating a long while. I used to do mobile home parks and storage centers and
Mhm.
commercial office condos and things like that. So syndicating was somewhat familiar to me. To do it for notes was a relatively easy transition.
Cool. Interesting. What is the difference for maybe some of our listeners? Hopefully, some of our listeners have the same thought. What's the difference between a non performing and performing note? Can you break that down and explain a little bit more about like how each of those would function in someone's portfolio?
Really the simplest definition there is one's paying, one isn't. You
Right.
know, performing is paying and non-performing isn't. But there could be timelines tied to some of that stuff. Non-performing defined by banks is usually delinquent more than 90 days.
Okay.
In fact, a lot of times a note, when I say a note, I'm usually referring to a note mortgage. When someone is 30 days late in most banking world, that's still considered current.
Hmm.
And those assets trade at the same dollar amounts. So now the average person doesn't know that, or the general public might not know that. They might say, well, it's 30 days late. It's late. Well, in banking world, they kind of lump that together with current.
Hmm.
So, and it's the same way with severely delinquent. These assets start to fall in various buckets, and they're priced accordingly.
Right.
It's that kind of thing. And same way when an asset's reperforming. When a loan is reperforming for like 12 months, it's like considered performing again. You know what I mean? So the value of it jumps up again, and then sometimes you have what they call like scratch and dent loans, where they're
Hmm.
paying 10 out of 12 months, those types. So there's a whole variety of definitions. I don't know that anybody needs to know all those right now. We actually have an ebook on our website
Oh, cool.
that actually it's like 100 pages, and it kind of explains real estate note investing a little more detail and has a glossary at the end.
Well, I'll have to check that out because this was helpful, but I definitely would like to learn some more. I'm just picturing an auctioneer with like, I mean, I have my karaoke machine in my room. I'm just picturing someone like standing up and being like, going once,
I don't
going
know that
twice.
I answered the auction question. The way that typically works is we push out an asset, usually
Mhm.
weekly, and there's a suggested bid price, but then people submit offers on them. And, it could sell higher or lower, but they tend to usually go higher in this environment, mainly because note prices are tied to real estate values, and real estate values have been up for a while.
Mhm.
So, generally speaking, in most geographies, real estate is up.
Right.
So, but note values are in direct correlation to real estate values. So,
Got it.
but then people make an offer, and there's definitely more buyers for notes than, say, the note fund, because in our note fund, especially, it's only open to accredited investors or high net worth folks.
Mhm.
Whereas a note, anyone can buy a note.
Right.
So there's more competition. And then that, I guess, that creates more of the auction effect, right? So
Right. It's less of a man screaming into a megaphone, a little bit more a little bit more of those systems and operations like you're saying.
now in a down market, you'll see, note pricing will come down. And there's times like in a down market, a lot of times the notes might have a higher yield than a note fund. And then in an up real estate market, the note fund might actually have a higher yield than the notes. You'll see it shift.
Cool,
So
interesting.
that's
Well,
another nuance to it. And then,
mhm,
yeah, so just like, you see the value of the note go up for seasoning, like the longer it's paying, the more it's worth.
mhm.
It could also go down in value because, it's paid off the bulk of the amortization schedule. You know how a loan has a 30-year amortization schedule?
Right, mhm.
Well, as you get in the second half of that, the value of the loan could drop. Same way, the real estate behind the note could go up in value, and now the note went up in value too. It has more equity protecting it. So that happens as well.
Hmm,
We kind of call those things like phantom appreciation.
uh-huh. Well, interesting. Thank you for that, and thanks for I feel less, I feel more informed now,
More
definitely.
informed.
I
That's
you
good.
know,
That's good.
I try to research as much as I can in my downtime here at CamaPlan because I feel like I'm a year in, so I'm still learning a little bit more about the financial industry. Because if you had told English major, theater major Jess that she'd be working at a financial institution and be, very happy and hosting a podcast, she'd be like, "No way." So thanks for that. Um, so Dave, I'm curious. I've been asking a lot of our guests this, and I'm just wondering how PPR, or how even you personally, with the COVID-19 crisis or pandemic and the panic and the crises surrounding um, finances and everything, that especially earlier this year, how you were able to take that obstacle and turn it into an opportunity.
Sure. Well, for us, it's kind of we have a couple things going on. One, obviously, there's some delays in some areas. And then,
Mhm.
we have to shift our focus on different revenue buckets based on what's going on in the market. So for us, like we can always uptick our note sales, that kind of thing, to make up for revenue where it's delayed somewhere else.
Right.
We don't get too much of a loss in revenue. We get more of a delay in revenue
Mhm.
because when someone misses a mortgage payment, it doesn't necessarily go away. It's not like rent that was missed, you
Right.
know, because it gets added to the mortgage with late fees and penalties kind of thing.
Mhm.
You know what I mean? So it's not like it just disappears. Sure, we might do forbearance agreements or things like that, but we don't hold a big book of business that's reperforming loans.
Right.
So we're not as impacted. And a lot of our portfolio was vacant first mortgages. So they weren't as impacted either because you can proceed with foreclosures even through COVID as long as the courthouses are open. You're seeing about it was roughly half, close to half the states were shut down for a little bit, but they're
Mhm.
reopening and things like that. So there's been some delay,
Right.
but it's not like a case where it went away. But then the positive is we're seeing a lot of disruption in the credit markets and we're seeing a lot of distressed debt starting to come back again. So we're seeing
Mhm.
cheaper prices of assets and we're seeing wider margins on the assets we're buying. So that's the big opportunity for us. So unfortunately or fortunately,
Yeah.
when there's a down market, it's a positive thing for our business. So the
Mhm.
biggest economic driver for us is unemployment.
Right.
Well, unemployment's been at unprecedented levels
Yeah,
ever,
exactly.
you know?
Mhm.
So as bad as that is for
Mhm.
everybody that's unemployed, don't it's not like we take that lightly, but that's what creates more distressed debt and more delinquency and more product for us to
Mhm.
buy cheaper. So it is kind of a positive out of a negative now that you say it like that. Not that we wish any bad luck on anybody, but
Right, yeah, no,
it does create other opportunities.
yeah, exactly. And you personally, do you still have properties that you have now that were you affected at all as a property owner or anything like that, or any of your tenants or anything? Were there any personal effects that you felt or any personal obstacles you had to overcome during this time?
Not too bad. I have 15 properties. I used
Mhm.
to have like 40 places.
Oof.
And I, on a personal level, and then I'm an investor in some apartments
Right.
complexes, and there were some delays of preferred returns or slowdowns,
Mhm.
things like that. Mostly for me, I was pretty lucky because a lot of stuff I've owned for, believe it or not, I've owned some stuff for 30 years plus, which is
Mhm.
scary.
Yeah.
And then some of it is at least half my portfolio is government rented.
Mhm.
So the government pays me. So I'm not worried about a tenant paying me or not.
Got it.
So I've been pretty lucky,
Mhm.
actually.
Well, that's good. Yeah. Thank you for sharing that. It's something that's I've found pretty interesting to hear from a lot of our guests, especially since this podcast has been stood up during COVID-19, and kind of asking everybody, so how are you holding up as part of just like a check in, but also to learn a little bit more about how successful investors have taken this lemon situation and turned it into lemonade. So thank you.
Our business, it's been helpful because we're working remote and
Yeah.
we're lucky we're not a retail business. So we
Mhm.
haven't really missed a beat. We haven't laid anyone off. We were able to keep everybody working. So it's been pretty positive, actually. The one thing I noticed about working remotely, in some ways, we get a lot more work done.
I've noticed that too.
Yeah.
I think I just like my coworkers a lot. I just wanna talk to them, but I found that I'm so focused. Well, when I'm home,
Yeah,
I try to
you're
get
like
more
more
done.
focused in one area, but you're how did a guy put it recently? The collective thinking of the team is in arrears a little bit because you're not meeting socially together, as
Yeah,
much.
yeah. I agree with both of those things. Like, I definitely feel like I have been way more productive in some aspects, but in other aspects, it's so hard to communicate with people over Microsoft Teams and effectively communicate what you mean. So sometimes it's just easier to pick up a
It's
phone and
hard to
be like,
whiteboard as much. Yeah.
yeah. Exactly. So as long as it keeps, everybody safe, I agree with you. Working remote has had its ups and had its downs, but our company was also lucky in that I think we've been able to really power through. Everybody's been able to get their work done from their homes safely. So we are very lucky in that respect as well. So, Dave, one question that I have for you as someone who loved to write, you're an author and you've had works published. How was that process? And what are some inspirations in terms of writing or in terms of as you were learning to become a real estate investor? Like, are there resources or books, online publications, anything you would recommend to people?
Oh, wow. I mean, I read a lot. And I read a lot of books at the same time. So it becomes difficult for me to tell you all the books I'm reading.
Yeah.
And I have books all over my house, like in every room. And I'm a weirdo too. I'll be reading, 5 or 6 books at a time. I almost can't read a book by itself from
Mhm.
like, just focused on one book, which is probably an illness of mine. But
Then I guess you and I both have it. It's
so I read a lot and I listen to a lot of podcasts and things like that too. But
Mhm.
I guess, gosh, what do I recommend? Well, it depends. It depends what you're doing. I
Yeah.
do, read a lot of, business books because I have a business, obviously, or self development, or I probably don't read enough fiction. But
Mhm.
I do like history and autobiographies and things like that. But I do, I am biased towards like real estate related stuff in some ways, and I've probably read mostly all of those.
Yeah.
I like positive things too,
Mhm.
like optimistic types of books.
Mhm.
So I do believe in that. So a lot of self development stuff like that.
Yeah, that's good. I mean, I think it's helpful to hear that, someone successful is reading books on how to continually improve themselves. I know I'm reading Gone Girl right now, and honestly, I feel like it's not the best to read while I'm like alone most of the time, but so I need something a little bit more positive. I'll probably look into a self-help book myself because it's very well written, don't get me wrong. It's just a little dark for the times. But
I'm reading a book right now, which I have like ADD, and I'm all in 100 directions. And my son got me this book. And forgive me for not having the title right, but
oh,
it's
that's
like
okay.
"How to Do Nothing," I think is the title of the book. And I'm like halfway through it, and he's like, "It is an interesting book. It's
Mhm.
like how to unplug, how to do nothing, and
Yeah.
how to And it's been a pretty eye-opening book on how
Mhm.
to do nothing because we almost feel like we have to be doing something all the time. I mean, I'm guilty of that. I feel like I have to fill up every second of every day. And it's like we don't allow time to think, or we don't allow time to unwind or relax or unplug.
Yeah.
We're always connected. And I am getting more into that in the last couple of years, where I meditate a lot, I read a lot, and I unplug a lot. And I actually recently I've taken off my like LinkedIn and my Facebook apps off my phone,
Mm.
and I've done away with trying to do away with email
Mhm.
completely. I've done away with 90% of it, and I was toying with just not having a phone number too. So I go back and forth. What I'm trying to figure out ways where I can Slack you to call me, but you can't call me, kind of thing.
Right.
So
Exactly.
it's
I mean,
like,
I've heard a lot of
I
celebrities
know
do
that
that.
sounds really weird or
Yeah.
bad, but I don't mean it that way. But it,
No.
it enables me to. One of the books I read recently was The One Thing by Gary Keller from Keller Williams, and
Mhm.
great book about really focusing on what's really important and having that time to really focus.
Mhm. As you were starting out as an investor and your business was growing, you were becoming so involved in creating programs, organizations to educate other investors. How did you balance your own personal life with business life and things like that? How did you figure out how to prioritize?
Oh wow, there were times I didn't.
Yeah.
Um, Yeah, I mean, it was tough in the earlier years because I worked a full-time job in the day, and then I went and sold real estate at night and weekends, and
Right.
then there were times my wife worked and I'd watch the kids when I got home too.
Mhm.
So it was just you're like two ships passing in the night.
Mhm.
And I think the bad part there was we felt like if we worked more, we would make more, we would have more, kind of thing, and it just doesn't really work like that.
Right.
And what we were missing was leverage. We weren't thinking about what could we leverage? What resources could we leverage? What resources don't we have that we need to leverage
Hmm.
or that we need to connect with? Like we didn't look at things like that. We just thought if we worked more, we would have more to get ahead. But then you're sacrificing something, right?
Right. Yeah.
So looking back, I look at like today, I'm more about leverage, even from my coaches that coach me.
Hmm.
It's really what can you leverage that's going to catapult you in the next 6 to 12 months, that kind of thinking. And when you keep asking yourself that same question, it changes over time.
Hmm.
One minute it's technology, the next minute it's a virtual assistant, the next minute it's a new hire, the next minute it's outsourcing this, the next minute it's whatever it is. It's education. There's always something we can leverage, whether it's capital or experience or you know, and we tend to not do that. We tend to want to do everything ourselves.
Yeah.
I think a lot of it's just the way we're brought up. We're
Hmm.
brought up to be, I don't want to say it, but it's average.
Hmm.
Most of us are just brought up to be average.
Yeah.
You know?
I can see what you mean by that. I do. I think that it's definitely that you look at what you're taught in school and I think a lot of my education, not to put down my education, but a lot of my education was a lot of, okay, well, when you graduate high school, then you go to college, then you get a job in the field you got your degree in, and then you work for the rest of your life and then you retire. And hopefully you have enough money to do that. And there was no sense of leveraging. There were nothing that was taught in a self-help book that most people wouldn't think to seek out. So I think you're right when you say that.
Yeah, it's kind of like we're taught what to think instead of how to
Yeah.
think.
Yeah. I agree with that. But I think that it's helpful to hear from someone like you again. I know I keep drilling that point home, but I think it is helpful to hear from someone like you that, there are strategies that you can employ and you don't have to overwork yourself to the point of just averaging out, which I think is really helpful. And going off of that, you have been such a key educator for and creating these programs and organizations that educate other investors as a founder of Strategic Investors Alliance and as a major contributor on Bigger Pockets. So, how did you get involved and how did you come about being a founder for Strategic Investors Alliance? And how did you get involved in Bigger Pockets?
Well, Bigger Pockets was kind of an accident thing. It was really a buddy of mine saying I should write for them, and it was my son who is actually a writer,
Hmm.
and he was an English major as well, and he was like, "Hey, you should write for Bigger Pockets," and I really didn't want to do it in the beginning, to be
Hmm.
honest with you, and he said, "Nah, you really should do it," and I would, I want to say vomit on paper, and then he would clean it up. He
Uh-huh.
would help edit me a little. And that's kind of what we did. And then, we wrote for many years, probably 4 or 5 years, pretty consistent. We haven't been writing much lately. We're working on a bunch of stuff, but it started like that. And then, of course, that led to a podcast, and then that led to a book offer, and one thing led to another. And, hey, would you write about real estate note investing? And I think it wasn't a case that we're the only person doing it. We just happened to be first or whatever,
Uh-huh.
we were the right place at the right time kind
Yeah.
of thing. And no, it worked out well. And we love Bigger Pockets. We do a ton of stuff with folks from BP.
Yeah, it's a really cool network for sure. And I know Carl's involved on it, and I've been involved with him working with that. And it is a very cool network of people, and it's a great way to meet people, especially I see a lot of people on the forums that are just starting out too. So I think it's a great resource, and it's a lot of fun to write with Carl on. So I agree with you. It's interesting.
We answer people every day on that thing. It's a way of giving back that's, it's not hard, it's just chime in every now and then.
Yeah.
And we do quite a bit of that, even if we don't have time to write, and Strategic Investor Alliance was a little different. That was more of a, when I had done some planning years ago, I realized the power of the family office, and the typical family office had investment committees and
Mhm.
advisors, and the smaller millionaires didn't. And I saw an opportunity to have, especially just like smaller real estate investors, they didn't really have the scale of the family office. In most cases, they were, smaller millionaires under 25 million in assets. And
Mhm.
they didn't have enough, they were very fragmented, so to speak. So the accountant wasn't on the same page as the insurance agent, who was on the same page as their stockbroker, who was on the same page as their accountant and their lawyer. It was just all fragmented all over the place.
Uh-huh.
And you could see that with their strategies and stuff. So, created a forum with some key people like Carl from Cama, and
Hmm.
we started out with our own networks, and it was like a little bit of an invite only group of high net worth folks, and we shared resources almost like Yelp for
Uh-huh.
investment advisors and alternative investments.
Cool.
And I kind of have a bias towards the alternative investment space, that the traditional investing world considers alternative investments as taboo.
Hmm.
And I consider it as, no, that's my primary.
Right.
They're like, oh, don't put more than 10% of your investments in alternatives. Keep them with me under my management.
Yeah.
And I'm the opposite. I'm more like, nah, I really like the alternatives, and I'll diversify in a bunch of alternatives. And that's mostly what I've done. I
Yeah.
still I have some traditional stuff, but not the majority.
Hmm.
It's the minority, actually. And maybe that's my secret sauce. I don't know. I've done really well with it, but I like the idea of having this group helps to, vet different investments, vet advisors. Another tool I utilize is Prescient, which is a due diligence company
Hmm.
that do background checks on different fund operators or entities. Between the combination of the group, so most of the stuff I invest in is coming from a recommendation from another trusted investor.
Cool. Interesting. Well, thank you for sharing some more about that. And I'm sure our listeners will be happy to hear about Strategic Investors Alliance and Bigger Pockets. So, as we wind down toward the end of this, Dave, one question that we do ask all of our guests that come on are what you think after, this whole big long discussion where I just kind of have grilled you about your life and what's a non-performing note versus a non-performing note, all those things. What would you say are your keys to building wealth and unlocking your potential in other areas of life? So it doesn't necessarily have to be a financial key or tenet that you've abided by your whole life, but just something that's informed the investor that is sitting here talking to me today.
I think it has nothing to do about what you make. It's what you keep.
Hmm.
And I think a lot of us get stuck on the income side of the world, and really the income side of the world is the highest taxed world.
Uh-huh.
Earned income is usually the least popular way for me to build wealth, right? And then leverage.
Hmm.
I believe we're taught leverage is negative instead of positive,
Hmm.
and we're not really taught good debt versus bad debt, that type of thing. We're always taught all debt is bad, basically. Those
Right.
types
Yeah.
of. It's who's my buddy Garrett Gunderson wrote a book called Killing Sacred Cows, and those are the types of money's the root of all evil or whatever, that type of
Right.
mindset. And we're those types of things are what I think words are important.
Yeah.
Words like I was at an event, and there was a guy I heard he was talking about, he was playing like a video game, and he's like, yeah, I'm just killing time. When people say they're killing time, what does that mean?
Wow.
It's
Yeah.
that's really a negative. There's a lot
Yeah.
of positive things we could be doing.
Hmm.
We shouldn't be killing time, which is our most valuable asset's time, right? Why do we
Yeah.
want all the financial freedom? We want financial freedom so we have freedom of time.
Exactly.
Yet people waste so much time on silly stuff, everything from we all do it. I do it too, but everything
Hmm.
from Netflix to Facebook, right? Like,
Yeah.
you can think of a million ways people kill time or
Yeah.
lose time and don't even think about it. But I think that's it's not always what you make, it's what you keep. And even the small things, I think people don't like to really budget things. But another one is to pay yourself first and to set
Hmm.
aside that profit before you pay your bills with what's left. Make sure you pay yourself first, kind of thing.
Yeah. Well, thank you, Dave. This has been wonderful, and thank you for taking the time to share your experience and all of your expertise with me. I really appreciate it, and I can't wait to share this with everyone.
No, my pleasure. Thanks, Jessica. Thanks for having me on.
Yeah, of course. So the one final question we do ask before we sign off, how can people reach you? What are the websites, social media platforms, anything you'd like to share with our listeners so that they can get in touch with you?
Oh, wow. Probably the easiest way is pprnoteco.com, which is our website. It's easy to reach out to us on there. or get our newsletter or free book, things like that. And we have a LinkedIn group called Distressed Mortgages Group. So you could, if you're interested in that, you could join that. And we do answer people in there, and people buy and sell notes sometimes. And then the other one is Bigger Pockets. Obviously, you can easily find me on Bigger Pockets. And we answer people's questions like daily on there. So it's a great way to connect with me and stay in touch.
Great. Well, thanks again, Dave. Really appreciate it. And I hope you have a great rest of your week and summer and time in remote working times. But tune in next week, everyone, to hear more from experts who have paved their roads to financial freedom, or call Cama today and learn more about how you can start taking control of your future wealth.
Thanks, Jessica.
Thank you.